I recently received this comment in my community tab on a question I had posted about topics that you would be most interested in learning about. So thank you to Mark, who posted he would like to know more about detailed information regarding funding for a new trucking business, working capital, equipment purchase, details are key. That's a great question because so many times when you're looking for funding for a startup business, in this case trucking, the biggest item that you can think about is your truck. What Mark alluded to is things such as working capital that you are going to need in order for your business to start from the beginning. This basic structure for startup funding can really go across any business model. And you can think of it basically you're going to have equipment, long-term working capital, and short-term working capital. In the example I'm going to give in this video, if you plug in your equipment, your long-term working capital or short-term working capital in positions like the truck, short-term expenses, and lines of credit, you will see that basically all businesses are mirrored in this funding structure. In my other videos I talk about the startup cost of trucking, and you can check out that video here. I'm going to reiterate in this video exactly how those funds can come from the bank. When you were looking to get funding for your new trucking company, maybe you're an owner-operator, maybe you're a guy who has a brother who drives, or maybe you just have a bunch of buddies that you know how to drive or that have been driving trucks for years, and you think, hey, let's start a business so we all can make money. You're going to need some startup funds to get you going. There's a lot of gurus out there that tell you using money that's borrowed to start a business is a bad way to start because you have loan payments and yada yada yada. Insert your guru knowledge. I'm not going to tell you which way is best. I can only tell you from my personal experience what we did, and it seems to be working for us. When you first start out, if you have really good credit, it's going to be rather easy just to get the truck. Most truck dealers will offer financing at the dealership based on your company's EIN, how many years you've been in business, and your personal credit report. There's not a lot of other information that they're going to ask for, so this is kind of the easiest way to get a truck financing. This is also more than likely going to be on new equipment. There's very few dealers out there that have used equipment that are also willing to finance. If they are willing to finance, more than likely those interest rates are going to be really unreasonable. Typically the reason that they have the used equipment is one, it was traded in for a new piece of equipment, or two, it was recalled by the dealership for someone stopped paying. This is how we picked up our second truck in our fleet. It was relatively brand new and it had 60,000 miles on it. The price was well below market, and at first we actually weren't even going to take a look at it because we thought, oh, low mileage, it might be a lemon. But it turned out the guy that bought it ran it for a few months and then stopped paying. The guy actually hid it in a barn for a few months from the bank so they couldn't repossess it. Finally, they found it, the dealership took possession, and they were able to offer it for sale. So sometimes you may be able to find that diamond in the rough, but I wouldn't bet your business on it. The other ways are traditional financing through a bank. The banks are going to require a lot more paperwork than the dealership will, and it's more than likely going to require a business plan. Check out this video here where I talk more about the business plan and the different parts you're going to need. So that covers the truck. Let's get into more detailed information of the finances you're going to need when it comes to working capital. Working capital is basically any expense that is used in your business to keep your business running. If you're going to start up, all of your costs that you're going to have to carry those for a certain period of time. Since most brokers don't pay the day the load delivers, and if you're not leased onto a company that pays you weekly, and there's a bunch out there like Landstar, JB Hunt, Swift, and so on, and with these companies you'll be leased as an owner-operator to the company. Typically they pay the week you deliver the load. Now let's say you work on your own authority, and let's say you get your loan through a broker and you deliver it. After you put all your paperwork in, let's say the broker gets paid in 2 weeks from the shipper. So they're not going to probably pay you for an additional 2 weeks after they get paid. So you're looking at potentially a 30-day window of getting paid. Meanwhile, you still have to fill up your truck, pay for any maintenance, upkeep, tolls, and all the other costs associated with trucking. This is going to be a huge hit on your cash flow, not to mention that you still have a monthly payment for the truck that you borrowed money to buy. This is where companies that do things called factoring. What a factoring company does is they take all of your bills of lading, and basically they advance you the money that you would otherwise be paid, and they're going to charge a fee for this service. We have never taken this route, so I don't know exactly what the fees can run, but I'm sure if you do a Google search and focus on factoring, you'll be able to find out. Now you're going to have to say to yourself, which is better, to be worried about when you're going to be paid and that your bills are going to be late, or that you pay a percentage to a factoring company. But again, that's going to be a personal business decision that you're going to have to make for you and your company. Now, if you're not an owner operator, but you own the trucking company and you have other drivers that are driving for you, you have to figure out how you're going to pay them, because they're going to want to get paid the week that they deliver the loads, or at most, maybe the next week. They're probably not going to be as forgiving as you are with the shippers and brokers. With that being said, probably the best way that you can hedge against having to pay a factoring company is by also applying for a line of credit. When you get your business loan for your truck, a good gauge on a line of credit would be to estimate your revenues for the year and roughly work on a 10% threshold. Round numbers, if you were going to do $100,000 in gross sales, you would look for a line of credit roughly around $10,000. Another way would be to find 2 months of your working capital, which is basically all of your expenses that would include your truck payment, fuel, maintenance, upkeep, insurance, multiply those by 2, and that amount would be good for a line of credit. That being said, you don't want to put your truck payment on a line of credit. This is only to be used for short-term expenses such as payroll. You would advance the line of credit, dump it into your business checking account, pay your employees this week. When you get your settlement checks, then you would pay the line of credit off. And you would just continue that trend until you build up enough cash reserves. Think of a line of credit as a buffer. And more about lines of credit and credit cards, you can watch this video here. To summarize what the borrowing structure would look like if your truck was $120,000, which is the average price for a brand new rig. I know there's a lot of arguments for not buying a new truck because of the DEF systems and the emissions and all of the electronics and things like that. But I have to tell you from my personal experience, if I were to go back in time when we started this business, I definitely would have looked at a new truck. But when you first start out, $100,000 seems like an incredible amount of money to put down on a truck. But had we done that, we probably would be really close to paying that truck off by now. Instead, we ended up using an SBA loan to buy our first truck, which was used. We got working capital, and guess what? We no longer own that truck. We ended up selling it this year, so we technically own money on a truck we no longer own. I'm not complaining because the loan did help us to start our business. I'm just saying that you have to look long term at your business strategy. You can spend $50,000 on a truck and be just fine and make plenty of money and be okay. Or you could spend $50,000 on that truck, put another $50,000 into it because of breakdowns, overhauls, and things like that, and you're in the same place as if you would have bought brand new. One of the reasons I'm saying that is one of our trucks just got out of the shop having a brand new turbo put into it. The shop bill was over $5,000, and basically we only had to pay $458 out of pocket because it was under warranty. I was going to do this video from inside the cab of the truck or on the back of the truck, but when I called my brother on Friday and found out the truck would be in the shop, this is the best I could do. So if you were going to ask me right now, I would never buy another used truck. Let me know in the comments if I'm totally off base, if you've been driving for years and your truck isn't held up, let me know in the comments. I just know from our personal experience and my opinion, I'm only going brand new from now on. So now that we figured out which truck you're going to buy, the other part is going to be your working capital. You're going to have to figure in your registration costs, your insurance, your permits, your taxes, your fees, all of that. You're also going to have to factor in any trailer costs. If that's the way you're going, such as your own authority with your own trailer, that's an additional expense you're going to have. Those prices can vary widely. They can go anywhere from a $30,000 flatbed all the way up to over $100,000 for a reefer or a refrigerated trailer. It all depends on what types of loads you are looking to haul. You take all of these costs, add them up, and that would be your total amount that you're going to ask for working capital. This is going to be long-term working capital. So now we're going to have 2 loans for this trucking company. One, you'll have 1 term and 1 interest rate, which would typically be 5 years for the truck. And you're going to have your second loan, which would be for your working capital and startup costs. That's going to be a lot less, and usually they're going to go probably 2 to 3 years on that. And then lastly, like we touched on before, you're going to ask for a line of credit. That's where I say you look for 2 months of working expenses and ask for that amount of the line of credit. At the end of the day, you're going to have 3 loans with 3 different payments. Based on those loan amounts, you're going to have to do calculations with what your truck gross is, minus all your expenses, and your net. Your net is what's going to pay your bills. So how to get your net? You take your gross, you minus your fuel, your lumpers, your tolls, and how much you want to pay yourself out of the business. And that's going to be what's left to make your payments. Your bank is going to do the same calculation, and the magic number that you want to get over is 1.25, or basically 125% of your loan payments. If all of your net income after expenses equals $5,000, then all of your loan payments better not be more than $4,000. I hope this video helps you out, and Mark, thanks again for the comment. I hope I answered your questions. If there's any other topics you'd be interested in me covering, post them in the comments, leave them in the community tab, or shoot me an email at mysteryofmoney00@gmail.com. I wish you the best in your business, and until next time, have a great day.